We talk about asset management. I mean, wow, what a couple of 3 weeks that we've had. I don't know if everyone's, quite gotten to grip to what exactly we've lived through. Davide, where are we in the banking crisis?
I think we are, let's say, whatever has been done over the last 15 years made the system ultra safe. Then 2 policy mistakes were done. Donald Trump increased the regulation of systemically important banks from 50 to 250, and that allowed SVB, and that created all sorts of risk in US regional, so anyone below 250 billion. And secondly, let's say, CS twice lost 5 billion, Archegos and Greensill, but by law could not have had more than 3.5 billion exposure, which was 10% of its equity, and so in a way had 2 massive fatal blows, even from a legal perspective, and that basically knock off confidence. I think, though, these, in a way, are 2 clear events. Mm-hmm. They're not systemic, because, thanks God, the re-regulation of the system has made that, for example, this could not happen in Europe. In Europe, there are any bank above 10 billion euro is regulated almost like JP Morgan. Yeah? And the reason is because in Europe we had so many small bank failure that the regulator said enough is enough. If you are a bank, it doesn't matter if you're small or large, you need to follow the same systems.
But Daniel, this is a bank run, right? Old school, we don't go to the bank and get cash out anymore, we do it on our mobiles. And this happened for both banks. So is this a crisis of confidence? Is this, people freaking out? Is it silly season? Or was it just that you can't raise interest rates from 1% to 5% without something breaking?
So obviously what you've seen with SVB and Credit Suisse is obvious cases of mismanagement. That's the first level, and I would agree with what was said before, which is that we're not on the verge of a systemic crisis. However, the culprit, if I may say, is the Federal Reserve. Let's be very clear. Taking interest rates from 0 to 4.75 and probably today to 5% over 8 months is irresponsible and was not necessary. Yes, inflation is the primary mission of any central bank. Fighting inflation is the primary mission of any central bank. But the second mandate that the Federal Reserve has is to support the economy. It was very clear that by being a bit more patient, Powell would have given himself a chance to see that inflation was slowing down. As you know, between the time you make the decision to raise interest rates and the impact it has on the economy, it takes a few months. You just need to see it through. They decided to preempt and raise and raise and raise. And now you see the cracks in the system. So in terms of how this banking crisis is going to unfold, I would say it very much depends on what central bankers are going to do in the next few months.
It's an outlier call. I mean, a lot of people say, look, they were behind the curve on every front. If you look at GDP,
they were behind the curve, but then they were ahead of the curve.
Too much. Do you agree with that, Davide, that it's the central bank's fault?
Well, certainly the word temporary that they used in 2020 and 21 was very unfortunate, because inflation wasn't temporary. It's obvious now that it's structural for many reasons. Now, I think, though, in this banking crisis, in a way, I would characterize as the banking crisis of the rich. If you think about it, SVB was the bank, Silicon Valley, all the tech guy, startups, and all the venture capitalists. I mean, the average deposit was more than $10 million. I mean, that's not a retail bank. That hit First Republic, which is the bank of the hedge fund manager and the private equity guys in New York. They panicked too. And Credit Suisse was the bank of the global rich. So the funny thing is, this time, the banking crisis happens when banks make bad loans. It's an asset problem. This time, assets are fine. It's a liability problem. And guess what? It's in banks which have, they're not the normal bank. A normal bank has 100 million deposits per branch. Here, Silicon Valley Bank had 10 billion. So in a way, it's institutional run, very concentrated clientele, all billionaires. And they all panicked. They're all on social media. And all of a sudden it says, oh, wow, I don't trust it, just move. But that's not what's going to happen to the rest of the banking system. That's what I want to make it very clear.
So what, if you want a safe, sound bank, don't bank to billionaires?
Well, I would say
billionaires
don't go,
that are on social media.
Maybe the question raised is, how smart are these billionaires? Yeah, if they had all the money in 3 banks, so they can have a bank run in 3 days. Maybe they're not that smart.
Daniel, when you go back to central banks, do you think now, if we look at the banking crisis and financial conditions and the possibility of a credit crunch that could be actually around the corner, Has it done the job for central banks in terms of raising interest rates?
It has. And the sad thing is that Mr. Powell will probably announce today a raise of 0.25 when, in fact, the impact of this credit crunch, this looming credit crunch, the fallout of the banking crisis, is at least 0.75 or 1% in terms of interest rates if you were to compare the impact in terms of credit contraction. And so, again, if he was not driven by financial dogma, he would say, I have enough on the table to believe that the economy will slow down as a result of a credit crunch, and as a result, I don't raise today. But he will raise.
But financial dogma, I mean, is that come into question when he's like at 3 or 4% inflation? I mean, it's high at the moment. When you look at 8%
but inflation is coming down. I mean, all the leading indicators are showing to you that the economy is slowly, is slowing down. And it's just a matter of giving the monetary policy time to have impact on the economy without raising constantly. Now, the fallout from the banking crisis, I think, is important because, I agree that we are not on the verge of a massive run on all the banks, but there will be very, very substantial consequences here. A is consolidation. You're going to see a wave of M&A, particularly in the US, but potentially as well in Europe. The second element is I think you're going to see banks specializing and returning to their roots. The Swiss had nothing to do with investment banking. They should not have touched it. They went for it because they saw themselves as global, competing against Goldman and the others. Big mistake. They just don't know this field. They are now going to return to wealth management, deposits, etc. The Americans have a culture in investment banking, will stay in investment banking. The continental banks are commercial banks, the French banks, the Italian banks. They have nothing to do with investment banking, a little less to do with wealth management, but they can be players in wealth management. So what you're going to see in the next few months, I think, is banks returning to their roots and their DNA. There is such a thing as a DNA of a bank.
And what's that DNA look like? Are we going to see more consolidation? We've been waiting for consolidation for over a decade. Is now the time?
Well, listen, in America it's happened. Pre-crisis, the top 5 banks had 20% of the earnings in the US pool. Now they're more than 65. And now you're going to see acceleration and consolidation in the regional banks. And certainly, the Fed is going to lower the threshold that has been always 50 billion. Donald Trump in 2019 raised it to 250. That's a big policy mistake. They're going to go lower. Secondly, they're going to apply the same liquidity ratio that Bank of England and the ECB has in Europe, also to the US regionals. In the US, in 2018, they said, hey, you guys are smaller. You can do pretty much whatever you want. Now we've seen what happened. I fully agree with Daniel said on all points. Both on the DNA means your history. Why? It's your clients. Yeah. Remember, for example, when Deutsche Bank wanted to compete with Goldman, had a problem. If Deutsche Bank, like now, foster his own clientele, the strongest German corporation and Mittelstand around the world is doing super well. The question is, who are your clients? And as Daniel said, if you're in Switzerland, nobody wants you to compete in New York in investment bank with Morgan Stanley. They already have Morgan Stanley.
But do we not need a European champion?
Well, we do have them. The issues in Europe, because of law, you can only have European champions country by country, because you have different calls, you have different, policemen. You can't say, as you know, Europe, we share the currency, we share the commission, but, a mortgage in France is different from a mortgage in Spain and a mortgage in Belgium. So as a bank, you don't really have synergies. What Daniel said then on rates is absolutely right. The unintended consequences of what has happened is the financial conditions have massively tightened. So today, availability of credit is much lower for a simple reason. Banks need to fund at a much higher cost. And as a result, there will going to be less availability. Secondly, at the same time, the price of that credit is going to be much higher. Now, then let's be clear. When we put money in a bank, that money doesn't go on Mars, goes in credit, mortgages, and credit cards. And if all of a sudden we all want our money back overnight, well, I'm sorry. That's why a central bank exists. That's why it's there to liquefy the banks. Yeah. So that's how it works. Banks are nothing else but utility of monetary transmission. And by the way, thanks God we have private banks, because every time, even in autocracy, they went for public banks, they all exploded. Yeah. In China, look at Russia, everywhere there is now, world is understood, you need a private pot of capital to risk so that you allocate credit with someone that is at risk.
I have many questions from, yes, go ahead.
No, if I may add, we are focusing on the banks. Obviously, clients of the banks are as important, if not more important than the banks. And the title of your session today is Strategies for Wealth Creation. The first element for clients is wealth preservation before talking about wealth creation.
Let's try not to lose money.
And wealth preservation, the basic element in wealth preservation is security. And what clients are learning today, when I say clients, it's wealthy clients, it's corporations, it's institutional clients. They are learning that if you don't have basic bank security, there is no point in talking about wealth creation. And so what we are seeing, and in fact, we built our business at Stanhope on this premise, the premise is that the best interest of wealthy families and entrepreneurs is to split the value chain between, on the one hand, deposits. You should have your deposits in a range of banks, not one. Banks have tried to sell to their clients the one-stop shop concept, which is give me all your needs, and I will handle it under one roof, and your life will be simpler. Great danger. Clients, all of them, should split their deposits between several banks. Point two, don't necessarily give wealth management to the very institutions that are handling your assets. You can give it to independent people. Point three, certainly do not give any kind of fiduciary duty like trusteeship or to a financial institution. Choose an independent trustee. And these are lessons that people should have learned post-2008. Many families have not learned these lessons. They are now scrambling to reorganize themselves and are willing and able to split the value chain as I described.
I feel like it's a business pitch, and so I have a question saying, is Stanhope's ambition still to go public?
Without any kind of rush, I think we are growing. We have grown organically. We have grown through acquisitions. We are now, managing about $33 billion across the world. We have 8 offices. We don't need to go public now. We will go public, at the right time. I know it's very unpopular, and I think you had a session about, private equity before, where one of the speakers said public markets are dysfunctional. They are not good for entrepreneurs. The answer is not necessarily private markets. The answer is fix the public markets. There are ways of fixing the public markets. And I think that you can have a management-led, a partnership-led company that goes public, maintains the ethos of a partnership whilst using the public markets for where they are best at.
I have many questions for Davide on being net long or short in your credit opportunities fund and your view on COCOs. But before we get to that, is this a watershed moment for actually asset managers? Does it change opportunities for some of the smaller ones?
Listen, I think over my 17 years career in investing in banks, there have been few events where some financial institution went zero fast. And I think investors need to see, what was, your exposure. For example, we're banking specialists. We were short SVB where we could. I mean, we're 99% long only. But where we can short, we're short equity. And de facto, we had zero Credit Suisse exposure in equity and 81 for more now than 18 months. Now, despite being 6-7% of the index. And I think the advantage of being specialized and bottom up, is that you do your homework. Today, as you know, 60-70% of capital is allocated by machine, computers, and passive. I don't trust it. I want to put my money in it because
Why not?
I'm one by one. And when you are the index, you get the good and the bad. And I'm sorry, it's like entering into a supermarket and buying all the wine rack. I mean, who wants to do that? Yeah, sorry.
Well, depends on the day.
Yeah, but my view is get a Brunello, get a Bordeaux, and I'll leave you the cheap wine. If you have the index, I'm sorry, you get it all. Now, having said so, I'm deeply impressed by the artificial intelligence use of Bloomberg because they can translate my accent and they actually speak better than me. Hence, I'm clearly going to go long Bloomberg AI. I'm impressed. I'll use it to understand what I've said.
I mean, I think we need to give the AI a clap,
sorry,
right?
when I rewatch the replay, it's clearly smarter than me.
Daniel, how should investors reallocate in this kind of market?
I think you have to believe that central banks are going to be reasonable, if not today, in the coming months, and that would potentially be the trigger for more positive both equity markets and bond markets. At the point where interest rates stop going up and potentially go down towards the end of the year, early 24, that could potentially give a boost to, or the anticipation of that will give a boost to public equity markets and bond markets. So I wouldn't quite tell you 60-40. You have to be more diversified than just 60-40. But you should keep a good amount of equities in your portfolios, and bonds will probably perform well in the next few months.
Davide, 81s or COCOs,
Yep.
I mean, are they dead?
Absolutely not, the opposite. So think about it. GDP globally, 100 trillion. Banks equity, globally, it's 9 trillion. So if you think about it, 100 the GDP, 9 equity. And then there is 3 trillion of so-called capital securities. Yeah? But basically, that's the buffer between your money depositors. Now, pre-crisis, that number, which is now 9 plus 3, so 12 trillion, used to be less than 5. So 15 years of re-regulation has increased capital from 5 trillion to 12 trillion. We love that. It's the buffer. That's why you can sleep at night with your depositor. Now, as a result, I think that buffer of 3 is about to go to 5. That's already in Basel III rules. What happened here is a couple of institutions did not respect Basel III rules. SVB, Silvergate, all these tiny banks were either exposed to crypto or don't have liquidity ratio and didn't filter the bond losses to equity. So they just were outside the rule of the, say, top systemically important financial institution. And in the case of Credit Suisse, they had twice a loss, which should have never been allowed in terms of size. So massive risk management failure, that's Greensill and Archegos. And as a result, then it was too late in a way. And in a way, regulators probably should have intervened back then, because you cannot have a 20 times standard deviation event twice, yeah, and nothing happens. So I think the idea that you have few coordinated incidents, surely accelerated by the fastest interest rates increase in history, after having been a bit asleep at the wheel, yeah, on the temporary 2021, has led to these events. But I don't think the system is unsafe. And I think the space for hybrid capital to protect our deposits, it's higher than ever. Of course, let's say, before you invest in a bond, which has been said, understand what it is. For example, we're one of the largest investors, 81 in the space. It's 7% of the index. We had de facto zero. Yeah?
Because you read the fine print in the prospectus?
No, the prospectus is always bad. That's a regulation. Yeah? But the issue is not the prospectus, is the institution. Forget the print. You can't invest looking at document. If not, artificial intelligence will be able to make money. I mean, they can translate perfectly, but don't give money to your computer. If you want to preserve your wealth, let's say. I'd rather give it to Daniel. You say.
Thank you. You use AI, Daniel. How do you use AI, actually?
Not yet, but we are thinking about potentially challenging our decisions with AI. So not AI as a driver for trading, but AI as a kind of inspiration, if you will, or sanity check to make sure that what you decide is potentially relevant.
How do you see actually rules and regulation changing, if at all, for asset managers on the back of these crises?
Well, you are going to see, I mean, there was a range of things happening in London before this banking crisis, showing that public markets have issues that need to be dealt with. And I think this crisis will probably accelerate the desire to reform and make our market more competitive in London and elsewhere in Europe. Certainly in the world of banking, in the US, they will return to the pre-2018 rules, I think, lowering the bar in terms of checking or imposing regulation to banks that may be smaller but need to be stress tested as often as the big banks. So I think that's an example of the kind of rules you will see. I would agree with what Davide said, which is that Europe has a much stricter regulatory framework, does not necessarily need to evolve. I think we have what it takes to make sure that our institutions are safe. The US had gone astray in 2018.
When you look at the big themes, certainly 12 months ago, actually 15 months ago, let's say, pre-war in Ukraine, it was ESG, it was climate, it was central banks and what they do, but it's all this geopolitics, maybe the end of globalization, or certainly the rethinking of capitalism. Does that still stand?
Look, we have debated about rethinking capitalism for the last 3 or 4 decades. Every time there is a crisis, you say, we have to change the system. And I think to a degree we changed the system in 2008, and capitalism has to be improved all the time. I think you need to put barriers to ensure that greed does not damage the public. But we have no other system, and I think that capitalism works. We just need to improve it.
Davide, on ESG, I mean, how do you look at ESG?
Well, listen, green transition, it's driven by scientists. We are cooking the planet. And hence, now, if you had asked me 50 years ago, does CO2 pollute? I think no one would have understood it. The fact that CO2, which, is the most basic product, of boiling water almost, the fact that then in the atmosphere cooks the planet, it's something that we need to deal. We have no choice. So I think on green transition, there's no time, yeah? And you'll see the consequences because, no one can last. You can last without a bank and without a bank billionaires. You cannot last without clean water. And clean water is going to become, a scarce resource. Hence, I think green transition is global and will keep on accelerating. Before we heard on the electrification of the planet, and is going ahead. I think then, if I look at some of the S&G, it's interesting, like SVB had a AAA rating by rating agency. I always says, if you want to preserve wealth, don't listen to rating agency. That's number one. Secondly, on the S&G, which I think is interesting, was the champion on S&G. Its board was the most diverse ever. No one ever done banking, yeah, and didn't understood that if you take daily deposits, you cannot invest in 10-year treasury. But that's a small print. And as a result, I would say that in the E, the green transition is crucial, and in anything else, it's key also to put the word C, competence, which I think some of ESG people have forgotten.
But you can be ESG and understand bonds, right?
Sorry?
And you can be ESG friendly and understand bonds. It's not because you only focus on ESG that you misprice your bond.
Of course, but the issue is some of the Taliban lost the word competence. And I think for example, in Europe and in the UK, if you want to be a board member, you need to be interviewed by the central bank. You need to know your stuff. If not, you cannot be appointed on a board. In the US, this doesn't happen. The CEO of Silicon Valley Bank was on the board of the San Francisco Bank, which is its own regulator. I mean, this is Burundi stuff, yeah? I mean, so I think, hence, the word competence matters too. And if we keep on delegating someone else's decision, yeah, then clearly, then you have this failure. So I think, in my view, green transition, key, social and gender diversity, key, with competence somewhere in the mix.
I mean, it's crazy that you have to say that, but yes.
Well, in the SVB case, it's obvious.
No, I mean, I would agree that ESG too often has become a box-ticking exercise. Firms do what they need to do, particularly listed firms, do what they need to do, but without thinking deeply about what they are doing. And I think that ESG should come with a degree of in-depth analysis of what it means to be compliant with E, S, and G, not just ticking a box. And competence is absolutely at the core of everything a firm should be doing.
Let me give you a quick example. In Tanzania, we have already planted 190,000 trees. We buy land, we plant trees. We don't sell any carbon credit. We give back oxygen to the planet. And then a couple of companies told me, oh, we would love to partner up. I said, surely, I mean, just help her out. We have 700 farmers, and we buy land and plant trees with communities. This, but you need a certification. Then someone showed up and says, $50,000 and you have your certificate. And says, sorry, I mean, we're just planting trees, the 7-8 trees we have in Tanzania. Says, yeah, but don't worry, we can tell you how much CO2 is going to come out of it. Well, and this is what we need. So I think the industry is very quick at creating the so-called label, tick the box, and make money out of it. I think society and capitalism to work needs the you man up, you take your own responsibility, you're auto-certified, and it has to be true. Because if you keep on delegating to someone else your decision, you're not preserving wealth, that's for sure.
Okay, in 1 minute each, I'm going to give you £100,000, or maybe a million. 100,000, I'm cheap. 100,000, where do you invest today, Davide?
For me, fixed income. I think terminal rates have peaked. High quality credit, including the safest financial institution in the world, are a buy today.
Okay,
10 to 12% in dollar.
£100,000, Daniel?
Not just fixed income, a portion in fixed income, and in equities, be ready to return to growth. I mean, I know that when I say that, I'm recommending doing exactly the opposite of what most people have been doing for the last year, fleeing from growth. Growth will return with a vengeance, i.e. technology, etc. They are restructuring themselves. They will, become even more profitable in the future. With interest rates peaking and potentially going down, and with the economy slowing down, the cyclical sectors will not do very well, and technology will do better.
Wonderful. Thank you so much for a spirited conversation, Davide Serra and Daniel Pinto.
Thank you.